we're actually quite excited about the go forward returns on a relative basis this year because the barbell should actually work even better now than it would have because yields have come down in the intermediate part of the curve.
Hello, you're watching Proactive. I'm joined by PT Asset Management CEO Sean Dranfield. Sean, very good to speak with you. A report from PT Asset Management at the end of last year argued that 2025 rewarded the belly of the curve and penalized your barbell positioning. As we head into 2026, what would need to change in the yield curve for that relative performance gap to start closing?
Oh, Stephen, thanks very much for the question. Good morning to you. So honestly, not a lot. So bonds are simply math. So, we're actually pleasantly surprised and happy with our performance last year, despite the fact that we had sort of a steepening of the yield curve, which sort of helped all of the bonds that are sort of in the index. And then in addition, we had quite a lot of spread tightening, both for IG corporates and agency residential mortgages, which are roughly half the index, which we had very little exposure to. But because bonds are always about the go forward math, when when yields go down on a bond, that means their price goes up. So all of those bonds that did well that were in the index are now priced quite a bit higher. Whereas for us, on a relative basis, because of the steepening of the curve and our positioning, we're actually quite excited about the go forward returns on a relative basis this year because the barbell should actually work even better now than it would have because yields have come down in the intermediate part of the curve.
Sean, you make the case that sectors like corporates and agency MBS now look less attractive after a strong 2025. Where do you see the most compelling risk-adjusted opportunities for bond investors in 2026?
Yeah, so as you know, Stephen, what we tend to do is we tend to combine what we call offense and defense because we don't believe anybody, including ourselves, can forecast interest rates. So offensively, and those would be bonds that would help you if rates go down. We still quite like the sort of 15 to 20-year part of the curve, and that's both the treasury curve and the municipal bond curve. So why is that? Well, on a relative basis, rates are a lot higher there. But as importantly, there's a lot more slope in the yield curve. And that's really important because if I dial the clock back 3 years ago, we had an inverted yield curve, right? When you have an upward sloping yield curve, bonds will roll down the yield curve. As we know, when yields go down, the price of a bond goes up. So the steeper the yield curve, the more go forward return benefit you get from that yield curve. And particularly the municipal bond market right now has a relatively quite steep yield curve. So you get both the benefit of relative coupon that's better and yield curve roll. And that combination, I think, really helps go forward returns for our offense. And right now, our offense is primarily taxable municipal bonds and the 20-year treasury. And then recently, we've actually been starting to buy tax-exempt munis as well because their go-forward returns are quite exciting. And then on the defensive side, we still really like structured credit at the short end of the curve. On a relative basis, spreads are typically wider there than they are for both corporates, and that's both IG corporates and high yield corporates. We tend to buy investment grade structured credit. And at that part of the curve, you can get 5, 6% total returns, rates up, rates down, rates sideways. And those bonds will help you defensively, i.e., if rates go up. So that combination, we think, will really help investors on a go forward basis in terms of providing a nice, steady, consistent rate agnostic total return.
Shape management is explicitly built around a 3-year horizon. For investors who struggled with underperformance in 2025, what should they be watching in 2026 to judge whether the strategy is playing out as intended?
Yeah, so what we found over 30 plus years is 3-year horizons are what works. So we've done what we call look back. So we will create a shape, which is the total return of a bond on a go forward 3-year horizon in different interest rate environments, and then do a look back and say, well, what actually did happen? And what we found is very consistently over 30 plus years that 3-year shapes are what really works. Now, that being said, at times when you get some very significant movement in rate patterns or spread patterns on a short term basis, like we did in 2025, you may underperform for a short period of time. But what tends to happen is the math sort of comes through for you on a 3-year horizon. So we're really hopeful that we actually pretty much tied the index last year, which despite the fact that we had none of the tailwinds of index bonds, we're really happy with. But now on a relative basis, we really think like the total returns will shine through in the ensuing couple of years.
I look forward to discussing the math with you as the year progresses. Sean, thank you very much for your time today.
Stephen, thanks so much.
Sean Dranfield, the CEO of PT Asset Management.